Hey everyone! Last week, as was widely expected, the Federal Reserve once again chose not to move rates. The Fed is still being very cautious about inflation risk, even though we haven't seen any significant signs of rising inflation yet. I don't think the Fed believes they need to lower rates anytime soon. If it looked like a recession was imminent, they might lower rates, but only if inflation was still under control. But I think the Fed is more worried about inflation than they are about the economy. And there are a few forces in play that could push inflation higher in the coming months. Tariffs, of course, are a significant factor. Not just consumer goods, which will likely start to see inflationary pressure this summer, but the tariffs on steel and aluminum that were increased to 50% on June 4th are another risk. It will take time for tariffs on raw materials to show up in the economy, but eventually we'll see the impact on everything from cars to building materials to appliances to aluminum soda cans. Another inflation force coming into play is the recent surge in oil prices. Since the beginning of June, the price of oil has increased by 20% to about $75 per barrel. Of course, that's tied to the Israel-Iran conflict in the Middle East, which could play out in any number of ways. A third force that could affect inflation is shipping costs. Since the first week of April, the cost to ship a container from Asia to the West Coast has increased by 167% to nearly $6,000. That cost increase could begin to put upward pressure on prices as well. But again, all of these inflation pressures will take time to manifest. But that's exactly what the Fed's thinking about. What will inflation look like in 4 to 6 months? Now, the other thing to consider is the overall health of the economy. So far, job creation is still relatively sturdy, and last week we got the May retail sales numbers. On an inflation-adjusted basis, headline retail sales are up by 0.9% from last year, but they dipped by 1.1% compared to last month. Inflation-adjusted core retail sales, which omits autos and energy, are up 1.7% compared to last year, but are also down by about 0.3% from April. Now, I have to say that retail sales are a little bumpy these days, so we need to be careful about our takeaways. A lot of people were front-running the tariffs, buying more stuff before the tariffs took effect, so retail sales were elevated in the first 4 months of the year, but it looks like they're beginning to taper a bit. Retail subsectors that are showing some signs of weakening over the last month include building supplies, restaurants and bars, and electronics. But the real question in my mind is how durable consumers will be in the second half of the year. And structurally, I think the consumer is still in a good place. Although total household debt continues to climb, so too have incomes. Household debt as a percentage of income is 60.9%, down by a full percent from a year ago. Auto loan debt is 5.5%, down 20 basis points from a year ago, and credit card debt as a percentage of income has basically been flat at 4%. In addition, total savings, including money market mutual funds, is up by about 3.6% compared to last year on an inflation-adjusted basis. So as long as the employment market holds and unemployment doesn't surge, the consumer should be well positioned to sustain consumption. The big question on that front will be consumers' willingness to spend. And although consumer sentiment bounced, it's still low by historical standards. That's what will likely shape the economy in the second half of the year, whether consumers remain sufficiently confident in the economy to keep spending. So while Wall Street is still assigning a 62% likelihood that the Fed will drop rates by 50 basis points or more by the end of the year, I think that may be a stretch. The Fed is still walking a tightrope. Inflation risks remain elevated while the overall economy looks durable. And that implies the Fed will hold rates stable for the next few meetings, potentially through the end of the year, which suggests interest rates are unlikely to come down. But for real estate investors, the current investment climate still looks solid. Fundamentals for some property types in some areas may prove to be a bit choppy through the second half of the year as trade challenges and uncertainty weigh on decision making, and interest rates may face upward pressure. But for most property types and locations, the performance outlook remains positive. And that's why I believe we're in a comparatively good investment window right now, especially for investors who keep their eyes on the horizon.